Stocks falling today as President Trump says the U.S. is moving forward with a 25% tariff on goods from Canada and Mexico starting tomorrow. China is set to get hit with 10% tariffs. Joining us now is Joe Lavorgna. He's the chief economist at SMBC Nikko Securities America, and he's a former chief economist at the National Economic Council during the first Trump administration. Joe, happy Friday.
Happy Friday.
We got the president talking right now about these tariffs. We also had Phil Gramm and Larry Summers, not normally op-ed fellows, in the Journal this morning talking about the dangers of tariffs as a general tool for economic policy. Why are you so convinced they're not inflationary if we're not exactly sure what they're going to look like yet?
Because, John, inflation is always and everywhere a monetary phenomenon. And if you don't get expansive money and credit creation, you can't have inflation. So a tariff is a price level adjustment. And the problem I had with today's piece in the Journal, it highlighted Smoot-Hawley. The environment was completely different then. The U.S. had been running 1% to 2%, 3% trade surpluses as a share of GDP. So by implementing tariffs, it was a self-inflicted wound. Today, it's the exact opposite. We're running 4% budget trade deficits as a share of GDP. So the environment is completely different.
Well, when most, I think, folks in the U.S., consumers, think about inflation, they think about prices being higher. President Trump did just say tariff costs are sometimes passed along to consumers. So, money supply aside, if prices go up for consumers as a result of this, is that a problem?
Here's the thing, John. What happens is the tariff is being used in conjunction with a lot of the other pillars to the Trump economic plan. So the tariff is an incentive to keep U.S. production here, at the same time to relocate production outside into the U.S. And the reason, other than the tariff being the initial incentive, is low and cheap energy costs, deregulation, and lower corporate tax rates on production from 21% to 15%. The tariffs will raise revenue. That will allow us to keep marginal tax rates lower. So the net effect on U.S. households should be positive, not negative.
I want to get into the oil and gas tariff piece of this specifically, because we also know since January 20th, President Trump has unleashed a wave of executive orders tied to reigniting energy production in this country, looking at things like pipelines and infrastructure, and basically, to your point, trying to drive inflation lower by making energy more accessible and more affordable. When you slap tariffs on other countries that import a lot of oil to us, what does that do, especially given the fact that I would imagine there are going to be geopolitical implications to this, too, which are not necessarily negative? Yes.
I mean, look, if you look at the economy, energy is about 13% of GDP. Imports are 11%. But the thing with energy is that you've got a lot of indirect effects. So if energy prices go from 75-ish a barrel down into the mid to high 50s, as they were under President Trump's first term, you'll lose at least, I calculate, at least half a point on your headline inflation rate. You lose another 80 basis points from all the indirect effects that lower energy costs have in terms of production, distribution of goods, services, airfares, all those sorts of things will come down dramatically. Because the U.S. is the consumer of last resort, the U.S. is in a much stronger negotiating standpoint vis-a-vis our other trading partners. And with respect to China, whom we have the largest deficit with, the U.S. economy is very strong. The Chinese economy is very weak. It's a totally different situation from 8 years ago. Look at the Chinese bond market. They're telling you growth is significantly weakening. It's much softer than the official figures show. So, again, when we look at tariffs, they got to be looked at holistically. They have to be looked at as a negotiation tool. They have to be looked at as a source for revenue. And to me, when it's approached that way, and not just narrowly focused, which so many economists are focusing on, looking at that narrow sliver, in totality, they make a lot of sense.
How are you factoring in changes to population and to workforce? Because we are starting to see the immigration crackdowns on illegal immigration this week, sweeps in major cities and places across the country. You also have economists who are saying this, too, is going to be inflationary.
Well, I mean, again, people kind of forgot the lessons from Milton Friedman. Again, money supply and credit growth are what cause inflation. That's what happened during the last 4 years. We had a massive increase, historic increase in government spending, and then the Fed monetized it. With respect to immigration, labor force participation is slowing. The BLS reported that they've overstated employment by 800,000 workers. So this notion somehow that we're going to run out of workers through immigration is just complete pie in the sky. It doesn't make any sense.